Uh-huh. Hey, everybody. Happy Friday. Let me move that out of the way. Welcome to Finance Friday. This is the show where we transform your relationship with money, transform the way you see money to help you grow and protect your wealth. So, share this video if you find value in it. We're going to be busting some really crazy common myths today. We'll get to some more myths, but these were the couple that were specifically requested. So we'll cover 2 today and make it short and sweet and get you off to your weekend. We missed last week. It was totally chaotic. Mm-hmm. Such is our life. We got locked out of the office.
Well, I was out of town. That's why it got messed up.
So when Tamara leaves, everything goes crazy. It's insane. Hey, Johnny. So, once again, follow us on Instagram, follow us on Twitter, at Novakovich Amy is my handle, or at Nova Wealth Management. Management's abbreviated to MGMT. And we share super quick, short tips on there all the time too. But today, we're getting into some myths. And this is so important because we have these conversations with clients, right? And we think that we're on the same page a lot of times. Mm-hmm. Like we think we're having the same conversation, and a lot of times we're not, because of some beliefs or some things that you might have learned in your past, or, you know, whatever.
Seen on TV, heard other people make recommendations.
Right. Talking to your poker buddies around the table. So the first one is, I don't even know what I would title it, but the number of shares that you have invested in a stock. The price versus the price of a stock. So I'm going to say that again. The number of shares that you have invested in a stock versus the price of a stock, and why that matters. And the myth is, we have people say, you know, oh, well, what stocks are you looking at? And we'll give a couple names, and they'll be like, oh, well, that one, like that Amazon.
That's too expensive.
Too expensive. It's at $17.
I wish.
A little bit off. $1,700 a share. Why don't we buy something that's like $10 a share? And if you are investing, let me just paint this picture for you. Let's compare our investment portfolios.
Okay.
So let's say Tamara has $10,000 to invest, and I have $10,000 to invest. Would you rather buy more expensive shares, or would you rather buy less expensive shares?
I want to buy shares that are going to make me money.
Oh, okay. So, do we think that just because the shares are lower priced, that those are going to make you more money than Amazon? Hey, Ray. So do we think that because Amazon is so highly priced that that's going to make less money than a stock that's lower priced? And the answer is no. If you're investing $10,000, if we both invest $10,000, and Tamara gets 10 shares of something, mm-hmm. or even 5 shares in the case of Amazon, you'd get 5 shares. And I buy something that's $10 a share. And I get, how many shares would that be on 10,000? I never get a calculator. My brain is fried, everybody. It's been a long week. 1,000 shares. So Tamara has 5 shares. I have 1,000 shares. Who does better? Who does better in our performance?
Well, what percentage do your shares make?
Right? So it's all about the percentage that they go up. That's the point here. It doesn't matter. Thank you, Ray. It doesn't matter the price of the shares as long as the percentage is the same. So if her $10,000 goes up 5%, if Amazon goes up 5%, and my 1,000 shares goes up 5%, we both have made 5%. Mm-hmm. We both have made $50. So, no, $500.
Right.
Man. Damn. $500. We both have made $500 percentage-wise. So the share of your price.
The price of your share.
The price of your share. Why don't you just do this? Share of your price. We are making these courses. I have to tell people, because now they're like, okay, she's a total moron. We have to tell people, we are making these courses, these educational investment courses. So Tamara and I, and Beth, mm-hmm. really Jim's the only one that has gotten a free pass on this somehow, have been watching these videos.
Over and over
and listening to these videos and seeing my face on a screen and talk at me, and it's like, it's completely frying my brain. Anyways, I'm very sorry. We both make $500 in this portfolio. We both make 5%. So it does not matter if you have an expensive share price or an inexpensive share price, whichever one, just like Tamara said, whichever one makes you the money, makes you the more money. If Amazon has more potential, then buy Amazon. It doesn't matter that you have 5 shares versus 10 shares, even on a dividend.
Right.
Even on a dividend.
You're not getting paid 5%. I think people look at it as per share. So if I have more shares,
Right.
I'm going to get paid more. You're getting 5% on the actual dollars invested.
Correct. That's a great point. So if you get a 5% dividend on 5 shares and you get a 5% dividend on 1,000 shares, it's all based on a percentage of that share price, not the number of shares. So you still make that amount of money, the percentage-wise. So it doesn't matter. So where it does matter, let's talk about where it does matter. So if I only have $1,500 to invest.
Right. Some stocks you're priced out of because you can't buy partial shares.
Correct. So in that case, if I have $1,000 or $1,500 to invest, I call Tamara and say, buy me Amazon. And she's like, oh, well, you can't. You don't have enough money. That's where it does matter. 5% on the total investment. Right. 5% on the total investment. So if they both go up 5%, you both have made 5%. It's that simple. It doesn't matter the price of the share. The value of the share. I should probably just stop.
You lost me on that one also.
Thank goodness it's only Ray and Johnny right now. I probably should have taken a pass on this week too, but we couldn't miss again after the whole debacle last week. This has just been a really crazy week. On top of it, I've been dealing with sick children. It's just always...
I think you should also cover that sometimes people think a lower price stock gives them more opportunity for growth. And
more upside because
yeah,
it's
more
lower.
upside because it's lower, and that's not always true. You know, it's really based on the company and
right.
how
Well,
the
because they
company
could do a
performs.
stock split.
Mm-hmm.
So stocks can split. So on any given day, Amazon could split and be back to $500 a share. You know,
Right.
Apple did that.
Mm-hmm.
When was that? 3 or 4 years ago? 3 or 4 years ago, I think. And Apple was starting to get very expensive, around $800 a share, and then they split. So then the share price becomes less expensive anyways, and now you own more shares. So they split. They lower the price and give you more shares. And again, it's all about the percentage. So it doesn't matter. It's not like there's not enough upside, like Tamara just said. It's not like you lose out on upside because the share price is so expensive.
Mm-hmm.
There's a ton of higher price stocks that do really, really well. Recently, Amazon, Priceline, Google. I mean, there's a ton of stocks that are over $1,000 a share that have been shooting the moon that do really
Right.
well. Hey, Jackie. So let's recap real quick and then we'll move on to the second one. So the first myth is that your share price matters on your stock. That, okay, if I call somebody up and I say, I want to buy a stock, and the stock that I want to buy is Amazon and it's $1,700, and they say, oh, well, can't we buy something that's $10 a share?
Right.
It's all about the upside opportunity. The share price doesn't matter. Okay? Hopefully I said that.
That sounded good.
Okay. The second one is that you should just buy dividend-paying stock. So we get all the time, well, is there a dividend on the stock? Well, what is the dividend? Well, why don't we just buy dividend payers? And that'll just be the strategy. We'll just buy all dividends. Like, what would you say about, what would be the first thing that you would say to a client that comes in, and you know we have a few of them, that it's like, well, what's the dividend? Why want a dividend?
Well, I would say, do you need the income? Why are you looking only for dividends?
Right. But they think that because it pays a dividend, automatically that it has more upside, or maybe it's just because that's just extra cash flow. Maybe Ray can answer, like, actually, on this one, I'm not quite sure what it is. I think it's just, they think they're already ahead because they're going to get a dividend every quarter.
Right, and I think many people, it's been drilled into their head that they need the dividend. That maybe it makes it a little safer. This company's able to pay money out, so they're safer and more reliable.
That brings up a great point. So maybe I should rewind because there's a lot of different levels of knowledge that watch this. So I'll just explain what a dividend is for those that may not even know what a dividend. And this is very simplistic, but some people may not know. So a dividend, companies have earnings, right? And they can do really two things with it. They can pump it back into the company, they can invest it back in the company, or they can pay it out to their shareholders. So if they pay it out to shareholders, that's a dividend. So you're right. Maybe it's just the financial stability.
Right.
Thinking, well, because they pay a dividend, it's
That makes them safer.
There you go. Yeah, maybe. But so here, let me give you some examples, right? Hey, Megan. So in the last few years, there's been some high dividend payers. Love you too. There's been some high dividend payers that have really went down, right? So like KKR is a huge one. They had a great dividend. It was 35 cents a share on I want to say the share price was like $43. At different times when the share price would fluctuate, it would be anywhere from 5, 6, 7%. And then they cut it in half back in 2015 or 2016. Literally cut it in half, and it's still cut in half. So although the share price has almost gotten back to where they were 2 or 3 years ago, the dividend is still cut in half. So I would tell you to go to so I forgot to put that on Do Not Disturb. Like GE, oh, great example, Ray. Thank you. Great example. GE has been getting killed, right? The stock price has been going down. They've got problems, and a lot of people, that's a great one, own GE because they're like, oh,
because it was a great dividend payer.
Yeah, well, and it's just been a company that's been around forever, and they've grown their dividends. And another one is, so KKR cut their dividend, it's still cut. The Blackstone Group is another one that went from $43 to $33 back in like 2015, 2016, or actually it went lower than that. It's around $33 now. And their dividend hasn't been cut, but they're still down from that high, about 23%. So, I mean, even at a nice dividend, they've got an 11% dividend now. But even at that, it's going to take you 2 years to get back to even where you once were. So sometimes dividend payers can actually make you lag the market. Mm-hmm. Like Campbell Soup is another one, down 23% year to date this year, just this year. And they've got a little over a 3% dividend. Super safe company.
Right.
I mean, Campbell's has been around forever. Well, when we think of Campbell's as like a recession-proof, everybody kind of buys Campbell's products. So you think of it as like a recession-proof. It's safe. Like Tamara said, their financial stability. But how many years is it going to take you to earn back if they stay down 23%? You don't know when they're recovering. The whole point is, don't just buy dividend payers. That's the true diversification is even within your stock, you have to have all different types of stock. You have to have some growth that don't pay a dividend, some dividend payers, some, there's a segment of stock called value stock that are just on sale. They're good stock, but they've just recently had a pullback.
But they can also be dividend or growth.
A lot of times they do have dividends. Yeah, value stock. So again, let's just recap this whole myth, is that you should just buy dividend-paying stock. Although dividends are great, they are not the only thing that you should ever go buy. So don't think that just because you buy a dividend-paying stock that you're going to make money. By no means.
Or don't think that dividend stocks are going to be the only thing you should have, because then you're missing out on growth.
On the growth, right. Well, Facebook took that dip in April about the whole data breach, right? Went down to 150. It's already back over 190.
Right.
I think it's over 190 today. So, I mean, you're missing out if you don't buy companies that don't pay dividends. They offer something that dividend-paying stocks don't.
Right. Because they're putting the money back in, and they are focused on growth, and are focused on reinvesting in their business.
Of course, there's risk. The point is there's risk to both. And in order to diversify out risk as much as possible, you have to own different types of stocks. Okay, so let's just recap real quick, and then we'll wrap this up. So, what was the first
Before
minute?
the phone rings again.
Before the phone rings. For those of you that missed it, I'm really off this week. But it's okay. We're going to have our courses coming out soon. First myth. Oh, the number of shares that you own. The share price. The share price, if it's lower versus higher, doesn't mean it's going to make you more money. Just because you buy a $10 stock versus Amazon at $1,700 doesn't mean the $10 stock is going to do better.
Right. Just because you have more shares.
Just because you have more shares
more money.
does not mean you're going to make more money. It's all on a percentage basis. And then the second one is just buying dividend-paying stock is not the end-all be-all strategy. You have to have a little bit of all different kinds of equities, because dividend payers, although they're great, may not have the share price appreciation. They may cut their dividends. Hey, Ryan. Anyway, I'll text you a question later. But you can't just buy dividend-paying stock, although, again, they're great, but they can't be your end-all, be-all. Those are two of the myths, two investment myths that we get all the time. And we'll probably cover some more down the road, but send us your topics on what you would like. Go to info@noblewealthmanagement.com or just our website, noblewealthmanagement.com, and hit contact us. and we're happy to take any suggestions that you have for Finance Friday topics, but these were a few that we had.
You can also send the topic requests in Facebook.
That's right. Yes, you sure
Since
can.
you're there.
Since you're there already. Message us. All right, guys, have an awesome weekend. Thanks so much for joining us. See you later.